Awesome. Okay. So whatever we have discussed on the equity derivatives part, stands good on the interest rate derivatives part as well, right? There's nothing like new concept that we are going to learn here, okay, to start with. So it's the same thing, that what we have learned, especially on the exchange rate, right? But what we will, start doing is, uh, I know most of you might have done like, arbitrage funds, you might have handled debt, you know, uh, you might have handled, some GSEC funds, etc., and all that stuff. What we will try to do in the first few minutes is we'll briefly touch what does the exchange rate derivatives consist of. Okay. In the case of equity derivatives, what is happening? We have indices, we have stocks, right? Primarily, what we are trying to do, we are actually doing either future hedgings, option, hedgings, buy, sell, all that stuff, is what we have been doing in the equity part, right? What are they? They are the instruments within the equity space for us, right? Now, in the exchange traded derivatives, primarily what we call as an interest rate futures, what are the primarily instruments that we generally deal with? What are those primarily? Anyone? Have a random guess?
T-bills and government security bonds.
Exactly. Primarily, we will deal only with, two instruments, primary, right? T-bills, which are 91, and then we have G6, which are, 10-year-old, okay? G6, 10-year bond futures, right? Now, before getting into that, let's understand the relationship between, the bonds and the interest. Okay. Now, what is going to happen there, in the exchange rate, equity derivatives? When the market goes up, it is all completely dependent on the market, right? If the Nifty is going up, the stocks can go up. The Nifty is going down, stocks can go up. It is all purely dependent on the market direction. Primarily the stock market direction is where we will actually take the futures position and options positions there, right? So what are those instruments here? Primarily, not what are those parameters here where we play. Anyone? You got my question?
Basically, it's going to be an interest rate changes. That what is the impact on that short term or long term as well?
Very
Or
good. Lovely. That's it.
is
That's
that
it, sir. That's what you need to understand. Don't worry. Okay. Primarily, let me repeat what sir just now said, right? In interest rate derivatives, primarily, we will focus on, two primary instruments, which are our T-bills and then government bonds. Okay. Government bonds, these are all 10-year-old, and then T-bills. T-bills are what? Short term. Right, guys?
91 days?
T-bills are short term, and then G6 are like long, right? These are the two instruments. Let's not get into the specifics, coupon, etc., and all the stuff, how it happens and all. We'll study in chapter 1 and 2, just on the basics part. Now, the primary, underlying positions in interest rate derivatives is completely dependent on only one important factor, which is your interest rates. Got it? Let me zoom this a bit. The most important factor which actually completely drives interest rate derivatives are your interest rates. What is interest rate? Your RBI interest rate there. Okay. Now you have to understand only two factors here. What happens when the interest rate? Okay. First of all, what is the relationship, right? The relationship between interest rate and then bonds are always inverse in relationship. Okay. Interest rate and bonds always inverse in relationship. Okay. What do I mean by that?
Opposite relationship.
Inverse opposite. Same nice, sir.
Interest
Whenever
goes
interest
and bonds comes down.
comes
So
down,
interest goes
That's
down
what I
and
told, right? Inverse in relationship, right? So interest rates generally goes up, the bond yields will come down, right?
yes,
Similarly, interest rates goes down, the bond yields
increase.
will increase. This is what it is supposed to behave ideally, right? This is a sort of a textbook thing. This is sort of what it is supposed to behave. Okay, I will talk about one scenario which where it did not. How many of you have done debt last year, fixed income as an MFT? No one. Okay. Had you had done like fixed income, like you would have been the investor would have been super unhappy because unfortunately what happened, I'll tell you what exactly has happened, not related to the exam per se, but this is more for from the information perspective anyways. Um, what exactly happened last year was equity did not deliver anything, and what people do is when the equity don't deliver the returns, people actually go to debt, primarily the fixed income, right? Interestingly, what happened was last year fixed income also did not deliver anything. Okay, we'll come to the reason in a bit. Let's understand this proportion, um, from the exam perspective, and then we'll discuss that part. Okay. Now, so the relationship is inverse relationship. Okay. So primarily, what do we play with in the interest rate futures? What do we play with in interest rate futures? What is this whole chapter all about? This whole chapter is all about three things, right? What is my interest rate? What is my sorry, what is my bond behavior based on my interest rate, right? And if I have a long-term bond and short-term bond, how do I hedge and how do I protect my money? And above all, how do I make money? That's what it is, right? Everyone clear here? What is interest rate futures? This whole chapter, it's completely dependent on interest rate. Based on interest rate, my bond behavior will change, right? Based on that, like if I have a long-term bond and then if I have a short-term, we'll see one example, just for your understanding purpose. If I have a long-term bond and a short-term bond, like which is say T91 and GSEC, like what is going to happen, in terms of my bond behavior, my yields. How do I hedge against? How do I protect my money in terms of I should not lose money? I should actually make money for my investor. You know, how do I protect my money and how do I make money? Okay. So the whole chapter actually revolves around this and this only. Okay. Everyone clear on this? And the whole hybrid long short, of course, there is an equity component, that is there. Of course, different AMCs are leveraging different set of strategies at this point of time, but like mostly, the hybrid long short strategies in SIF as a category revolve around this also. Okay. Any questions on this to start with? Let me take a quick pause here. Any questions? Clear, everyone?
Yes, clear.
Perfect. Oh, now what did we? I will actually do one quick example here. Uh, See, this chapter we need not study too much in detail. We are not looking to become a fixed income expert here. We'll study properly. We just understood this concept, right? We'll study purely from the exam perspective only. Okay. Now, first, let me take one quick example here. We'll study all this stuff and then I'll go through the PPT. Okay. So imagine now GSEC bonds are like 10-year bonds, right? For example, like today is 2026. This year is 2026. I have bought a GSEC of 2036 maturity. Okay, guys. I bought a GSEC of 36 maturity, which is yielding me something like 6.1%. Okay. And imagine now this bond value, what I have purchased this for about 5 crores, right? Now, what is going to happen, for example, is I'm expecting 1 second. Okay. I'm expecting rise in interest rate. Okay. Now, kind of similar situation what we have, with RBI now. Why inflation is going up? There is so much of uncertainty with whatever is happening in West Asia. The interest rates have come down, from 2025 onwards, but this could be even a potential scenario that can even happen. Okay. Now imagine, now I'm expecting an raise in interest rate somewhere around October, November timeframe. Okay. Okay. Now, please put yourself on mute. Thanks. Yeah. I'm expecting a raise in interest rate, sometime around October and November timeframe, right? And there could be a second scenario also, that might be the government is issuing a new bond, okay, somewhere around in 6 months with higher maturity. Okay, here what am I getting? 6.1. Imagine now I might be getting 6.3 or 6.4 or 6.5. Just leave it for that, thing there, right? Now, what is going to happen for my GSEC here? How do I behave? First of all, if I'm an investor, or if I'm invested into this, how do I behave? Tell me a couple of scenarios.
First, yields will come down.
Yields will come down. That's what it is, right? Very good. Yields will come down, which means what? My G6 value will sort of come down, right? My portfolio value will come down. Let's put it this way. Will? Okay. Next.
So what
Build on
I
it, because this is what is the interesting question, for us. And this is the most question that you will get. Yeah. Go ahead, sir.
sir, and how do you I see yields will come down, so the price of the G6 also has to come down.
वो
Bond
तो हो गया वो तो हो गया next.
Okay. And then it's going to, how do you I hedge this? How do you I can make sure that I get that same returns?
Hmm.
That is one of the
Correct. Very good, right? So there are a couple of scenarios here, right? So primarily, this is the question. I know. I think you will give me the answer, and this is the most question that will come from the chart, right? If the interest rates are actually going up, right? What is going to happen to the G6? The yields will come down. Okay. So if the yields are going down for me, that means my portfolio is going down. How do I protect against that? We discuss this multiple times in options and futures. I will hedge it. I will also telling you I will hedge it. But how will I hedge it?
So the short-term bonds you can play it around.
Short-term bonds?
by
No.
I'll buy high interest rate that bonds or
buying the
this
future.
or FDs.
No, sir. One more attempt.
Short sell,
Sorry?
shorting
Come in.
the
Lovely. That's it. Shorting the complete the sentence, sir.
interest rates.
Actually, shorting the bond itself.
Shorting the futures.
Shorting the bond itself, right? See, imagine, say, let's go back to equity part, right? See, if I'm holding Reliance, don't get confused on this. This is same ditto only, right? We will simplify this here a little bit. Imagine now we are holding a Reliance contract which gets expired in the month of August. Okay, I don't want to sell the Reliance contract. Okay, why? I'm anticipating the price of the Reliance will go up. Okay, pakka मैं तो confident हूँ that Reliance price will go up. Okay, Reliance will make me money. Okay, but now whatever is happening in the West Asia tension war, US Iran fighting and that etc. and all that stuff, I'm anticipating might be a little bit of a dip for 1 to 2 weeks or 3 weeks. Okay, everyone clear? I'm expecting a dip of 1 to 2 weeks or 3 weeks in Reliance. Okay, but what is my long term? My long term is Reliance will go up and I will make money. Okay, now to protect that, right? for that 1 to 2 weeks or 3 weeks, what will I do?
We'll
What?
put, I mean,
Bingo. That's it. I will actually sell Reliance, right? Either I will sell futures or I will actually take a put position. Everyone clear on this? This is what we discussed, right? Over the last 4 or 5 days on that, right? What will I do? I have that position to hedge against that, to negate my losses. What will I do? I will actually take a opposite position, which is sell futures or buy a put. By doing that, I'm making money, and I am like, whatever the money that I'm losing, say, suppose on the long part, I'm covering on the short part. That's what it is, right? That's what we discussed multiple times. Everyone clear there? Cool. Guys,
Yes.
now replace Reliance with GSEC. That's it. Replace Reliance with GSEC. GSEC में क्या होता है, right? GSEC, of course, I can actually, there is hold until maturity, and there are some bonds which you can even sell before maturity as well. But say, imagine I'm holding the GSEC until maturity. Okay, what is my maturity? 2036, right? Now there are these short-term, movements that are happening in my instrument. Okay, when there is short-term instruments that are happening in my instrument, because of what? In the equity case, US Iran war was my, external factor. In the case of my GSEC, what is my external factor? My interest rates, right? So because of the interest rate, what is going to happen? My GSEC is going to come down. Okay. So what am I going to do here?
sell.
That's it. Sell government bond futures. That's it. Understood, everyone? This is the most important question that you will get. Okay. So imagine, up flip karenge, right? Imagine now if you feel that interest rates are actually going down, what will you do?
Buy.
We'll
Buy
long.
government
Buy.
bond futures. Got it?
Buy.
It's as simple as that's it. This is exactly what the whole chapter is all about. Okay, it's not like I'm brushing it off, but this is the exact question. This is exactly what you need to understand the concept from this chapter perspective.
So these are generally futures only, no, sir, we buy. Means hedging we do with futures, and there's nothing to do with options.
Sir, you can bring in the options also here, right? The options you can actually do with T-bills, etc. and all, but like primarily, selling futures is what we generally do. Yes.
Okay.
Yeah. Okay. Everyone clear on this? Clear? Cool. Perfect. Okay. Now let's actually move on. Any questions? Okay.
Sir, you're selling the futures here.
Tell me, sir. Sir, you're cracking. Sorry.
So you're selling the futures and so can you hear me, sir? So you're selling the future of the bonds, anticipating the bonds will come down, yields will come down. See, the anticipation may not work it out in your favors. Then how do you have been hedged out?
See, that is the tricky part. That is actually the skill set of the fund manager. Since you mentioned, might be I will digress a little bit here, and then this is exactly what actually has happened in 2025. Okay. If you allow me, for 2-3 minutes, so ideally what should happen just now, we said, there is an inverse proportion, right? So when the RBI started decreasing interest rates from 2025 onwards, everyone are aware of that, right? We are in that industry now, right? So what I guess ideally, should have happened, the GSEC should have gone up, because that is what the textbook says. That is what ideally, that is what it is supposed to behave, right? But actually, from the Indian perspective, two interesting things have happened. Okay, why two interesting things have happened? I know I'm recording this, but it's okay. And we have to learn this. So G6 are also, there are two factors to this, right? There is a demand part and there is a supply part, and even in G6. Yes or no? See, every instrument will have a demand and supply. What is stock market? There is a bid and ask. People come and fight each other, right? Buyers and sellers. So what happened was, at one point of time, the government wanted to issue more bonds. Okay. If you see the recent budget, right, every year, when the government actually raises 10 lakh crore from the market, this year they wanted to raise 80 lakh crore from the market. Okay. So government actually wanted to raise more money from the market, which means what? There is more issuance of G6, that is, sorry, let me put it this way. There is a lot of demand. Let's understand that. Whatever happened is this budget, but there is a lot of demand, sorry, my bad, guys.
Lot of
There's a
supply.
lot of supply, that came into the market. Okay. But unfortunately, what actually happened was, last year, RBI, see, if you are a fixed income manager, right, imagine if you have bought a, 10-year GSEC, okay, say for example at 6.2, okay, and say if your yield is coming down to 5.5, 5.6, etc. and all, okay, and imagine now there is another bond that is being issued in the market somewhere around 6.4 or 6.5, yield, again for a 10-year maturity, right? What will you do as a fixed income manager?
So I will go and buy that 6.4.
But what will you do with this existing one?
Then
Sorry,
I have to close this position and take that new one.
right? Everyone with me? You have to close this position because I'm getting into the losses, and then I have to, switch to my another position there. What RBI told was, and who are the big absorbers of this, bond market? Primarily it's bank, insurance companies, and institutions. It's not you and me, right? It's not our investors who generally put in this lakhs of crores of money into the debt market there, right? What RBI told at one point of time was, what? If you had purchased the bonds, with a certain maturity, you have to hold it until the maturity. You cannot sell it before the maturity. Understood? So what primarily has happened is there is lot of supply, and also there was a restriction that came through saying that you have to hold the bonds until the maturity. You cannot sell this, whatever that 5.6, 5.7 that has happened to me, you cannot sell it. Okay. And there are a lot of other external factors. So what will happen in this particular scenario? Tell me.
The liquidity crunch will come. There's a panic as well.
Not liquidity crunch. Lot of supplies there. Not
Temporary,
much.
You have to invest more.
temporary value will come down.
That's it. Bingo. Who said, sir? Vijay, sir? Is that you?
Yeah.
Yeah. That is exactly what has happened. What exactly has happened? G6 were somewhere around 7.4, 7.25. It has fallen all the way up to 6.2. Ideally, what should have happened? That 7.5 should have gone up to 7.6 or 7.7. But with all these external factors, what exactly has happened was that 7.25 actually has come down to 6.2. Now I think they have stabilized it. Now it has brought it to 6.8 because, people even in fixed income market has to make money, right? So to answer your question, sir, ideally what we are trying to do, in fact, that is what I told, people did not even make money in, fixed income market even last year. In fact, I don't know how many of you attended the KFI Mutual Summit, in Bangalore, I think Rishi was talking about, there was no money that was made last year in fixed income market, and I built on top of it, the same conversation there. So this is proper textbook thing, right? What is textbook thing? When the interest rates are actually going up, G6 will fall. When the interest rates are coming down, G6 will, go up. Is the proper textbook thing, but there are a lot of other external factors that are even associated within this entire proposition there. Then I think it's a skill set of the fund manager on how to manage them. So ideally, what we are studying for the exam is what is required. Again, as I said, textbook thing. But in real life scenario, textbook generally doesn't apply, right? You need to be more pragmatic and practical there. So people actually struggled a lot. Last 1 year has been even a challenging not only for equity fund managers but also for fixed income managers. Okay, clear? Anyways, everyone on this particular concept?
Sir, one question. This may give a negative effect on the market, sir, bond market, because that is what we are lacking in this. Because next
actually
time
did,
also
no?
it can happen, the same thing can happen.
It actually did, no. That's what exactly. I mean, now they're correcting. They can't let it, happen it again and again and, keep that going on. They've corrected it. Now the bonds are like, climbed up to 6.8. Now I think from the last time when I checked, I need to check what is happening now. But now they are stabilizing because debt market is also an important market.
Right, sir.
Cool. Everyone understood this part. So the whole, chapter revolves, it's all about that, right? Interest rates, what is the relationship, etc., and all that stuff, right? Um, okay. Now I will introduce one another concept. It's just more of a one-liner thing, right? You need not understand too much into this because there's a very famous and what I meant to say, lovely question for NIS for this exam, right? So there is this concept called duration-based hedge ratio. Okay, nothing to learn in this concept. Primarily, what it says is interest rate futures. What is interest rate futures? Our T-bills and G-sets are actually used in hedging the positions. Got it? So we only spoke about interest rate futures and G-sets, right? But there could be another scenario, right? So imagine if the interest rates are actually, going up, okay? And what is the ideal scenario? My G-sets are coming down. I can actually do a short-term hedge also. What is that short-term hedge? I can sell bond futures because, like, to hedge it. And I can also do one another position there. Which
You can
is,
buy the puts as well.
no. What I can do is I can also analyze the behavior of T-bills, because my T-bills are of a shorter duration. Because they, when does it get expired? Like, in 91 days, right? So imagine if the T-bills are 3.1, 3.2, 3.3 maturity, etc., and all that stuff. What I can do is, I can take two legs there, right? One is I can sell the bond futures, and then might be I can actually even buy, depending on the situation, right? I'm just taking a hypothetical example here. I can actually buy, T-bill futures which are expiring in 3 months, 6 months, or 9 months from now. Got it? Clear, everyone?
Yes, sir. That's the only thing available, right?
That's the only thing available. Primarily, what I'm saying is these are the instruments you can play around to either hedge or to take the option positions. That's what I'm trying to emphasize here. Okay, everyone clear, guys?
Yes, sir.
Any questions? Okay, perfect. Okay. Again, I think this is pretty much it. In terms of like what this chapter is. What we will try to do is we will quickly.
Kiranji,
Boliye sir.
see, whatever that strategy, these are a standard actual scenario point of fund managers when they actually managing the fund and all, they'll apply these strategies apart from any other strategies would be there.
Sir, in the Indian market, unfortunately, we don't have much options. So in the US market, we have many more options. But I think from the Indian market, yeah, these are some of the strategies, that they generally use.
Okay.
And of course, in the SIF hybrid long short, you also have equity. Some of the fund managers are really playing very good on the mix of hybrid and equity, debt and equity. That's why I'm liking some of the funds. We'll discuss that later. Once you get to that other stage.
Okay,
Yeah.
thank you.
Cool. What I will primarily do is, I will actually, touch on the bullish, call spread for us, right? So what is bullish call spread? Let's go back to our house example. Quickly tell me, what am I going to do here?
By Buy call and sell call.
Buy lower strike,
By a lower strike,
Lower,
And sell higher strike.
higher.
sell higher strike.
Sell
Okay,
higher.
right? Everyone clear on that, right? So very, very important question here. Okay. So same thing, right? Imagine now if I'm very bullish on bond, bond prices, right? Thanks. If I'm bullish on bond prices, right? What does it mean? I'm expecting the interest rates to go down, right? That's what it is, right? When the bond prices are going up, I'm expecting the interest rates are going down. What I will actually do is, so I will buy a bond with a strike price of something like 98.75. Just taking a hypothetical example, right? But what is going to happen? The scenario what I have discussed can also happen, right? So I have to hedge against my position because I would never know what is going to happen. So what I will do, I will actually sell a bond with a strike price of how much?
102.
That is like, too many bips there. Let's not go too many bips. It's something like, so something like 99.25 or 99.50. Got it, everyone? What I'm going to do, I'm buying a bond with a strike price of 98.75. I'm bullish only, but also I wanted to hedge, if something happens. Okay. So what I will do, I will actually sell a bond with a strike price of, with a higher strike price, which is something like 99.25, 99.57. Clear, everyone?
So what is the current price you're assuming, sir?
What is the current price that we are assuming?
Yeah.
So, for example, like, I'm expecting, say if I'm, when the interest rate going down, right, might be I'm expecting the bond price to go to like 99 or 99.10 types primarily.
Okay.
Okay, clear, everyone? We are discussing house example, I just, mapped that, to the interest rate derivatives, nothing much to, we will already learn the concept, it's the same thing here, except that the house thing on the equity there, we are replacing that here with the bond here. That's it, nothing else. Okay, clear? Good. Okay. Okay, let's quickly go through then our, PPT. Any questions so far?
So
Any
options,
questions?
so options also can be played in interest rate, right?
It can be, yes. We'll go through this, let's see, I think I have, some examples. I'll upload this also, so you can go through this. Primarily just to, okay, let's quickly scan through this, right? I think we discussed about 3 types of market participants. Everyone remember this? This is a very, very famous, interesting, good example. I mean, not famous question that you will get in the exam. Hedgers, speculators, and arbitragers, right? Who are we? Retail traders, who are we? Where do we fall?
Speculators, and most probably so you can move to hedges with your learning.
We will, So we're all speculators. Speculators are the ones who take the market risk. Okay, just remember that point because it's a very important question. Arbitrage is where you exploit the mispricing between the products. Okay, hedges are the one like what we have done is they transfer the prices to the market. We discussed this multiple times. Okay. Yeah. The same thing. With some examples there. Okay. Primarily, what we have done this one, right? What is the instrument? Primarily T-bills, 10-year is GOA. The whole exam focuses mostly on only these two, and especially on GOA bond futures. We need not study. See, there are other instruments called like certificate of deposits. We have like CDs, commercial paper, and like repos. We need not study that. I think that's not even covered in the the NISM book itself, right? But just for your understanding purposes, there are CDs, repos, and then we have commercial papers, which are also other instruments, especially in the interest rate futures market. Okay, Market side, we discussed this, link to the expected direction of the market and the contract one, right? Short hedge, we know this, right? What is happening if there is a protection against price and a decline? What will happen here?
So if you can make money.
Yes, I'll take short positions here, right? You can go through this, I need not even explain. We have done this multiple times. See, one thing what I will also say is, don't actually put too much of time and energy, into this PPT also. This is purely for your explanation. Mostly they don't ask any of this stuff, right? You understood equity derivatives mein kya hota hai, right? It's the same thing, Just remember, short hedge, portfolio based hedging, we discussed this, right? Again, yeah, just now also we discussed this. Okay. One thing what I want you to focus on, very, very important, especially in this exam is, when we do the questions, we will do that again one more time. But the value, what is the contract face value of a GOI? We did that when we did the questions.
2 lakhs.
Very good. Very, very important. Always remember that, the face value of a GOI contract is 2 lakhs and it goes in a multiple of 2 lakhs. Okay, 2, 4, 6, 8, 10. Okay. So that means you can purchase 2 lakh, 4 lakh, 6 lakh, 8 lakh, 10 lakh. So whenever they're asking you about the size of the value of the contract, you have to multiply with 2 lakhs. Again, I'm saying we will do that when we do the questions. Just remember that, in the back of your mind for now. Nothing else is required. Again, I don't see the thing is, I can go through this, and then I can say that, like, I'm actually teaching econ for you, right? Interest derivatives, but these don't come in the exam, right? So I will give you the PPT and like you can go through that, higher level types. Option spreads, we discussed vertical, horizontal, diagonal, right? Horizontal spread is also called
Calendar spread.
calendar spread, right? Everyone? What is the main difference in the calendar spread? Anyone else? What is the main difference in the calendar spread, guys?
It's in current and the next month we miss to the transactions or what we said.
Primarily, we take a different expiry. Okay, we'll take a different expiry. Okay, so you see here, right? Same strike, same type, different expiry. Remember that part. Okay. Here, what is happening in vertical spread? Same expiry, different strikes, bullish or bearish using calls or puts. Okay. Diagonal, it is different strike and different expiries. Okay. Okay, we have done this. I think housing example, we spent decent 2 days on, limited loss, limited profit, payoff, and all that stuff. Yeah. Same thing. Yeah. Horizontal spread, just now we discussed calendar spread. Yeah. What is difference between straddle and strangle?
Straddle is
To
in the
input
money,
expiry.
strangle is out of the money.
Out of the money. That's it. Okay. Nice. Very good. Straddle is in the money. Strangle is out of the money. Okay. So I'm buying at exactly 1 crore. Always, if you get any doubt, go back to our house example only, right? Straddle 1 crore. I purchased, like, I expect either ways. I am exactly taking at that particular same strike price. In case of strangle, I'm little greedy, so I'm going at 1.05 and 0.95 lakhs. Okay, that's the difference in the money and out of the money. Okay, so same thing here. Covered call, is long bond plus short call. I can just remember that. Nothing much to explain there. Protective put game. Yeah, it's the same thing. If you want to go through that, go through this. Yeah, I think maybe let's go through this here, right? So primarily, if the trader is expecting the bond prices to fall, what is it going to do? We discussed this, right? Sell government bond futures and buy government bond put options, right? So primarily, if the fund managers with a strong rate expectations adjust the portfolio, if they expect the rates to rise, what will they do? They actually shorten the duration. Expect the rates to fall, they will lengthen the duration. Okay, what do you mean by lengthen the duration, shorten the duration? Either square off the existing positions and then play with the contracts with the shorter duration or with the longer duration. Okay. Yeah. Again, don't worry about this. I made the notes because I have to make it, but the questions do come, right? I will tell you, but like there's no point. Okay. Any questions on this? I'll upload this and you can go through this, but no, that's primarily it. Might be just let me, for your sake, let me quickly open this chapter and we will do the questions, because I don't want you to feel, oh, Kiran did not teach anything in interested derivatives. So let's go through this quickly. What chapter? Chapter 5 is 145. 177.
You just click it here only, sir, on the chapter number.
No, that's what, yeah, 178. Let me go there directly. Okay. So this is what it is. Let's quickly do these questions here, because these are mostly the questions that you will also see in the exam, right? Okay. I know you have the answers here, but like hedging for multiple bonds and portfolio can be done by using
Duration-based hedging ratio.
just now I explained, right? See, whenever there is a hedging for bonds, that happens, it is actually methodology is called duration-based hedge ratio. That's it. Just blindly remember that, nothing else. I think I discussed this just now here, right? No. See, interest rate futures are actually used in hedging the positions. Okay, it's called duration-based hedge ratio. Okay, bullish vertical spread using put strategy. What will you do? Don't look into the answer and tell me though. I can't hide the answers though, but
Buy the put option with the lower strike, sell the put option with higher strike.
yeah, it's the same. See, what is happening here in the case of let's quickly see if I will try to make you remember this, right? Bullish call spread में क्या हो रहा है?
So we are buying with the lower strike and selling the higher strike. Simple.
Yeah, everyone with sir,
Yes.
Vijay sir,
Expectation.
Ashish sir, Naveen,
Yes.
right? What are we doing in bullish call spread? We are actually buying at lower strike and selling at higher strike, right? What is that we are doing? We are actually doing the call there, right? I'm doing it like 1 CR and then selling at 1.2 CR. The right to the buyer there. I'm getting the thing from the seller. It's the same thing which holds good even in the put strategy. Instead of the call there, the put will come here. That's it. What is happening in put
generally,
strategy?
So
Sir, one second.
generally, I
Let me
remember like
complete.
this. Call means okay.
Sir, 1 second. Here the same thing is happening. Buying put option at the lower strike price and selling the put option with the higher strike price. Okay. In the case of bullish, yeah, go ahead, sir, Abdul sir.
No. Generally, I'm telling you. I was reading this. Bullish call means it will go up. So we'll buy it lower, and with the same way the put selling will go up. So like that I remember. Sir.
Yes.
Selling means it will go bullish.
Right.
Input.
No, you just need to remember those 4 quadrants. You figure out how you will remember. That's it. I'm telling you from the bullish perspective, lower, sorry, buy lower, sell higher. That's it. You know, in the bearish, I think bearish actually it is reverse. That's it. Okay. You just put it on the paper 2 times and you should be able to, you know, get this one correct. Okay. Expect interest rates will go up in the future. What will you do?
Bonds.
Short
Sell
them.
the government bond
Sell,
futures,
sell.
or what else can be done in case if there is another option here?
Then buy the puts.
Buy the puts also. Right. Nice. Very good. Okay. Dash is where trader buys particular month contract and take the opposite of the same contract a different month.
Calendar spread.
Whenever there is a month, right? You know, whenever there is different expiry, you know, I won't say go blindly, but like, you know, you go through the sentence, but most of the times the answer will be calendar spread only. Okay. Last but not the least, limitation of interest rate derivatives for hedgers is mainly due to
Standardized contract, non-nullity of all kinds of underlying instruments. Okay. There are only 2 instruments there, so that's why it's mentioning there.
So primarily, you know, this is exactly why I think someone asked in previous classes also that, you know, can we as retail investors can do participate? You know, unfortunately we don't, you know, even though we can actually do currency, you know, on different markets. Interest rate derivatives are little, you know, tricky, and we cannot do that because why? There's not much of availability, and you know, these are all very standardized contracts there. Okay, so just remember, you know, standardized contract and non-availability of underlying instruments. Okay, so this is what it is mostly. You know, these are the questions that you will generally have mostly. Okay, any questions on, you know, chapter 5 interest rate derivatives? Don't get bothered about all these examples and all that stuff. You don't worry about that at all. Okay. Any questions?
Sir, you told about a few days back that calendar spread, the low margins is going to be explained. So why it's low margins, sir? It's the risk is the same, right? You are buying with a different month itself. For example, I'm anticipating a bullish view, but I'm buying it in July, and I'm also buying it in August as well. So
So
why?
what are we doing? Like, you know, we are okay. I'll show that to you, sir. Maybe first thing I'll let me pick up couple of examples and I'll show that to you tomorrow. I think
Sure.
I don't have examples now. Let me show it on the brokerage on how we will set up the calendar spread, then you will understand.
Sure.
First thing tomorrow is your answer. Oh, sorry, we'll tackle your question. Okay. Any questions, guys?
Kiran sir, actually currency derivatives also is not possible for individual to act, no? Right?